Said 6 consecutive trading days of lower oil prices. $60 will buy you a barrel of West Texas Intermediate crude. Phil Weiss, oil analyst at Argus Research, he's got some buy ratings on energy companies. He, in one case, says, drill, baby, drill. So, Phil, what's going on with oil prices? Let's start with the macro picture. $60, you think that's fair and stable?
I don't know that it's stable. I think it's around the fair price, but as we've seen with the dramatic moves and volatility in this market, it could certainly go lower from here, even if that was below fair price.
And is this why? Because we don't have any fundamental demand for any of the refined products? I mean, let's leave gasoline out for just a second. Diesel, jet fuel, all the distillates, no demand.
That's right, Pim. Demand is down, and in the past, when it was going up, it seemed like there weren't any fundamentals supporting it, and now it seems like the fundamentals are starting to catch up and the price is pulling back because demand just isn't there.
All right, so we are awash in a sea of crude oil. Then why do you like the stock of BP? Let's start with that major. Is this all about what's going on internally with the company, cost-cutting, for example?
Well, that's one part of it. That cost-cutting is important because it gives a company an opportunity to boost its margins even while prices are going down, or at least maintain them because of the fact it's pulling some costs out of the system. Another thing I like about BP is it's got a really nice dividend. It's paying about 7 to 7.5% yield. And so even if the story takes a little bit longer to develop than we think, you're still getting paid money to wait. So I think it's a good place to be. The dividend looks to be safe for this year and next. So that's that's a big driver in my liking that stock.
What about BP's downstream operations, things like those refineries? Are they going to be able to produce any profits this year?
They could produce some. The one difference for BP is that in 2006, in 2007, and part of 2008, it had a lot of issues with its refineries. There was a big explosion in Texas City. They had a facility in Indiana that had a lot of downtime, so that they weren't running a lot of their plants and they were actually losing money, so that while everybody else is suffering, BP can have some improved performance just because it's got more capability online.
Now, when you talk about BP's internal operations, what about their ability to replace the oil that they're actually selling? Are they being able to do that?
They've done a pretty good job of that over the last few years. The company believes that they can grow production at least 1 to 2% per year for the next 10 years or so, based upon what they have now without finding anything else. They've had a pretty good record of replacing their reserves over the last few years.
Now, you mentioned BP's dividend. It's around 7%. Is that dividend safe?
I believe it is. When I look at when I model out BP's performance, it seems to me that it should be safe. The company has a little bit of room to take on additional debt if it needs to, and management seems pretty emphatic that they want to maintain that dividend as well, so I think that they'll be able to do it.
Phil Weiss, if you take a look at the company using your discounted cash flow models, why is it selling at a discount to its peers?
Well, I think one of the reasons is that the margins that it's gotten, because it hasn't taken all those costs out yet, are lower. There's been some concerns about the weak refining business that we've had over the last few years. There have been some concerns in the past about its ability to replace reserves. So when you look at those different things, those are some of the reasons that it might be trading at a discount. It's just not as efficient as Exxon. I mean, Exxon has the best margins in the business, so it should trade at a premium relative to a company like BP.
Now, BP owns a 50% interest in TNK-BP. That's a Russian joint venture. Are you paying for that if you buy the stock, or do you get it free?
I think you get it pretty cheaply, if not free, because there were so many issues over the last couple years related to the management of that business. It seems like they're making progress in fixing that. And I think that the market in the past has discounted that operation because Russia's a difficult place to be. BP seems to have a handle on how to operate there well enough that they can still benefit from that.
All right, we're going to continue the conversation. Phil Weiss, he's got a buy recommendation on the shares of BP. He's got a $60 price target. The shares closing at $45 today. Coming up, why the deepwater drillers will do well when everyone else is dealing with lower crude prices. Coming up.
We don't mind people making money, but when you see, like I said, this year, oil prices going from $35 to what, last week we hit $70. For what reason? When you got all-time high supply and low demand. We got to take this excessive profit-taking, manipulation, and speculation out of this market.
I think the market has taken care of what it needs to take care of. I think most of the speculation has run its course. And I'm always fearful when the government wants to begin intervention. Once they get their foot in the door, they tend to put their arm and their head in later, and they never leave.
Two conflicting points of view. Congressman Bart Stupak questioning the integrity of oil trading. Also, Dennis Gartman saying he wants the government to just kind of stay out of the markets. This is Taking Stock. I'm Pim Fox. My guest is Phil Weiss, oil analyst at Argus Research. So, Phil, what about this potential market manipulation? First of all, is it real?
You know, you have to think that there's something going on there because we've had volatility at levels we haven't seen in 20 to 25 years. We had prices go up to $147. They went down to $33 within just a few months. The prices don't always seem to move on the fundamentals, so it seems like there's something else going on besides just what should be driving the market.
But, Phil, couldn't it just be the explosion in ETFs and the ability for people of all types of investing classes to speculate, both long and short, in what's going on in energy?
Well, that can certainly have an impact. There's definitely a lot of speculation. Plus, with the concerns about inflation and things like that, there's a greater desire for people to hold hard assets. So that would be something else that factors in, too.
All right, let's talk about getting at those hard assets, specifically the deep water drillers. You've got a buy recommendation on Transocean, symbol RIG. What do you think about RIG? What's their backlog like?
And they have a really big backlog. It's about $30 to $35 billion. A lot of it's with their deepwater fleet. They have the biggest deepwater fleet in the industry. That backlog seems pretty solid. And when you look at the clients that those contracts are with, they're all generally take-or-pay contracts, meaning that as long as Transocean performs its services, it should be pretty protected. There's been a couple small issues with some smaller contracts that the operator had problems, but for the most part, we think that backlog's pretty safe, and it provides a nice margin of safety for the stock.
So, Phil, does that backlog counterbalance the fact that we seem to be idling rigs at an alarming rate?
I think it does to a large extent because the revenue that it gets from that backlog allows it to still make profit, allows it to still generate positive cash flow, and it can overcome any negative association that comes from stacking a few rigs that don't have contracts right now.
Now, you just lowered your EPS estimates for Transocean for 2009. Why'd you do that? Is that because day rates are coming down for the rigs that are actually being used?
Not for the ones actually being used. It's more for the ones where contracts expired, especially in the jackup fleet, where either a couple of those rigs were stacked or to get new contracts, they have to lower the rate. The deepwater rigs are generally booked through 2010, so you're not going to see any change in those rates.
And what kind of price target do you have in the stock? Still $100, even though the stock's trading at, what, 67 today?
That was my latest price target. You know, given that the stock has come down a little bit, it's quite possible that after they release earnings, we could lower that target a little bit, too.
And so should investors be concerned if they see the price of crude fall even further below $60 a barrel? Is that a sign to start to get out of the stock, or are you saying that it's pretty bulletproof even if the price goes down, let's say, $10 a barrel?
You know, I think it is pretty bulletproof if the price was to go down another $10 a barrel because so much of its value is tied up in the future. And my longer-term view of oil prices is that they can go higher than they are this year and, you know, maybe potentially approaching the numbers that we saw last year over the longer term. So they have the ability to get oil from difficult places in the deep water, which is really where the biggest amount of reserves are being found. And so I think that helps protect them, and so that those contracts go out in the future, that oil's out in the future. So I'm not that concerned about where oil prices go today. I'm more worried about the long term when I think about a company like that.
For Transocean investors, they've been used to dividends, whether they're special dividends or dividends in the form of stock splits. You think we're going to see anything in 2009? We didn't see anything last year.
You know, I don't think we're going to see anything this year. Transocean reincorporated in Switzerland last year. They have gotten approval for a stock buyback, and I think that that's going to be their preference over dividend. I'm not projecting a dividend in 2009 or 2010 for RIG.
All right, let's move on. I want to ask you about what's going on at Noble Energy. Same thesis. Is that why you like this company? But they've got a lot of onshore operations, don't they?
No, Noble doesn't have onshore. They have a little bit bigger percentage of their fleet is jackup relative to Transocean's, but they still have a number of deep water rigs as well as some more coming online. It is a similar thesis. They have about a $10 billion backlog, but it's a much smaller company. So on an apples-to-apples comparison, the difference in the backlog isn't that material. They've got good relationships with Brazil, where we have a number of potential contracts coming on as Brazil tries to exploit assets like the Tupi find that we've got off the coast there.
So there again, jack-up rigs coming out of the marketplace. Doesn't that give you a little bit of pause when you look at Noble Energy?
It gives me a little bit of pause, but not a lot, because one of the things I really like about Noble is that it's got does a really good job of managing costs and keeping them low. And the last time we talked with management, they said that if oil prices were to fall to $40, they actually think that they could benefit even more than they do at this level in some ways, because they're so financially strong. They only have about $400 million in net debt, and that allows them, or gives them, the opportunity to potentially acquire assets from distressed companies at good prices. There was a rig that was auctioned off a few weeks ago. They were a bidder on it but didn't get it. But if prices were to fall, we think that there could be more potential to to enter into transactions like that.
All right, I want to thank you very much. Phil Weiss coming in from Argus Research, sharing your thoughts about oil drilling companies. Got a buy recommendation on Noble as well as a buy recommendation on